So I'm joined now by Head of Research and Director at ETM Analytics, George Glynos. While, we saw all the leading central banks across the globe pumping up rates to cool the inflation that was brought about by the stimulus during and after the COVID-19 pandemic, we saw the Turkish President Tayyip Erdogan saying, no, we're not going that route. We are keeping rates low. During his election campaign earlier this year, he said, and he believes that high interest rates destroy domestic production and make structural inflation permanent by increasing production costs. Now, George, if any of that economic theory is true, Turkey won't find itself with a 40% inflation rate and a cost of living crisis.
Yeah, and in fact, Ilze-Marie, that inflation rate that you're talking about has come down due to the very high base effects. In fact, the unofficial inflation rate was hovering something in the order of about 120 to 130%, and that was about a year ago. And the official inflation rate was hovering somewhere between 80 and 90%, if you can believe that. So, very high inflation. Quite clearly, the Turkish government doesn't believe, as we do, that inflation at its base level is a monetary phenomenon. So we've always maintained that it is a monetary phenomenon, and if you lose control of your monetary policy, and in fact you disregard the very important role that interest rates play in not just monetary policy, obviously, but in terms of the impact that it has on the economy, then you are liable to suffer consequences. And one of those consequences is, of course, runaway inflation. Well, for starters, the market was looking for a lot more. You must remember that despite elevated levels of inflation, Erdogan actually reduced interest rates. So he felt that interest rates were the enemy that needed to be fought. He didn't view it as simply the price of money. He viewed it as a lever to pull to try and extract or generate an economic response that he thought would be favorable, because at the end of the day, I think he believed far too much in the notion that investors borrow in order to invest. There wasn't this appreciation that for borrowers to invest, they need to have a pool of money to borrow from in the first place. And if your interest rates are going to be too low relative to your prevailing interest rates, well, then why would anyone want to hold money in a bank account? Because in real terms, you're effectively going backwards. So you've always got to try and understand that interest rates need to be balanced. It needs to be a mixture that helps both the providers of funding and the demanders of funding with equal benefit. So it can't all be one way. If you do it all one way, you're distorting effectively the price of that market, or the price of the market and how it functions. And the net result of that is that we will have distortions in the way that it all functions. So the minute you play around with the price of any market, you're going to get those distortions that come through. In this case, they were distorting the price of the money market. Yeah, and so you've got to start the long process of jacking up interest rates to where they should be. And for an emerging market, typically what you want to find is that you need to get your monetary policy to a restrictive territory. Typically, that means that you're running positive real interest rates. Well, if you've got interest rates, if you've got inflation at 40%, then you need to have an interest rate that's perhaps even higher than that. and it starts becoming very painful. This is the reason why, for the most part, central banks try to contain inflation, because the lower the levels of inflation, the lower the levels of interest rates that they can run with. Again, I'll go back to the idea that if you are a person that has saved a lot and you wish to deposit those funds in a bank account, you want to make damn sure that at the very least you're not going backwards in real terms. If you're going backwards in real terms, then there's better things to do with that money and you simply won't lend it out. So it creates a different kind of problem altogether. So right now, interest rates are simply too low. Instead of jacking up interest rates, and I think it was 650 basis points, they needed to have jacked up interest rates more like by a full 10%, 1,000 basis points. And they needed to be quite clear that 1,000 basis points wasn't going to be the end of it. 1,000 basis points was just going to be the first step. And perhaps the next interest rate hike would have been 500 basis points and a further 500 basis points, until such time as the market gains confidence that, in fact, this central bank is very serious about reducing inflation, is going to run contractionary territory, is going to give savers the necessary ability or the desire to want to save their money in a bank account, such that the bank then has the funding to be able to lend out to those that want to borrow at those prevailing interest rates. And so they are out of balance. The entire system is out of whack right now, and they've got to try and recalibrate it all such that there is a decent balance between lenders and borrowers. And when you get to that point, you will find that the system settles back down again, that the negative speculation against your currency doesn't take place, that your price stability returns, that inflation drops back down again. And as it does, so you can reduce your interest rates once more. But the problem right now is that we're far from that point. So Turkey has a lot of work to do. And they need to learn that distorting the price of a market doesn't necessarily give you the result that you're looking for, even though at face value it may seem like a good idea.